Hello and welcome back to the third edition of the Fun Friday podcast with Lone Star Capital. Your host, Craig McGrother, the Director of Business Development at Lone Star Capital, alongside a friend, a partner, everything else in between. Welcome the founder and CEO of Impact Equity, the one and only Randy Smith. How are you today, sir?
I am doing really well, Craig. Thanks so much for having me on one of your first shows. I'm excited to be here.
Yeah, well, it's all about on our end, uh, having the best community possible, sharing, collaborating, and I thought there'd be no one better to have on the show than you because you've been such a great partner, not only on bringing equity to our offerings and being just a consistent, reliable partner, but also really spreading the Lone Star love around. I say this to everyone, and I've said this to you. If we could have 10 Randy Smiths, 10 more of you who refer us all these people, we'd be in such a great spot. So we can't thank you enough for your enthusiasm, your partnerships with many deals, and we kind of want to unpack that here on this show and just
Sure.
learn more about you. But thank you so much for being here and being such a great partner.
Yeah, absolutely. And I think it's the partnership is a two-way, goes two ways, right? So the energy and effort and enthusiasm I have for Lone Star is a result of what you guys are doing. It's not simply Randy is this type of partner for everybody. So I think it's important to note that early on that you guys are the very most important part of that partnership, because without a good operator to partner with, guys like me don't even have companies. So yeah, thank you guys for what you're doing as well.
Yeah, absolutely. Well, let's get into some of the fun questions we have set up. We know each other pretty well, so we're comfortable. So the show will have great flow, is my guess. But tell me about what you did before starting Impact Equity. Your background, maybe how you fell into this world. Because a lot of people, I wanted to be in real estate from the get-go, but a lot of people kind of just stumble into real estate at some point in their life. Maybe they acquire a single-family home, maybe they invest in a deal, and then they refer millions of dollars of clients, realizing, wait, there's a business there that I just didn't think about. So
Yep.
what was your kind of start? What did you do before getting into real estate? And then, now that you're a capital raiser, kind of unpack that story for us here.
Yeah, absolutely. So I was a corporate America sales guy for about 25 years. And I spent the majority of those 25 years with two Fortune 100, Fortune 200 companies. Um, I spent 10 years with one organization and was a top performer there, did very, very well. I led phone sales teams for 8 or 9 years, and I ended up getting laid off on that position, like almost 11 years into my tenure there. And at the time, I had not been investing in real estate. I had done fairly well with my finances in that I didn't have a lot of debt. I didn't have really, really expensive toys, so we were okay. But that severance had a ticking time bomb that was coming, and every day that passed, it got more and more stressful. And I ended up having to make compromises on the types of jobs that I might consider taking. So it was just extremely, extremely stressful. So fortunately, I ended up landing at an amazing organization where I spent the last 10 and a half years of my career. But about halfway through that tenure, I started remembering back to the days when I got laid off before. So I started kind of planting the seeds with my wife, started doing the research, started listening to the podcast and the books. And then ultimately, I made the decision to start actively investing with all of this money that I was making, because I was a very high income W-2 sales guy. So 5 years in, I started buying single families out of state. I bought a couple in Kansas City using the turnkey model. And then I did a bunch of BRRRR strategy single families in Atlanta, and found out very, very quickly that the simple math I had done was that I either needed 100 single families or I needed 50 paid off to kind of continue the lifestyle that I wanted after leaving corporate America. And the thought of doing that 50 or 100 times just, I mean, it was overwhelming. There's no way I could have pulled that off. It's certainly not in the time frame that I wanted to. So I started looking at passive investing, which ultimately leads us to where we are today, because I fell in love with passive investing. And then ultimately, when I got laid off again, the majority of my household expenses were covered from my passive income from investing with folks like you guys.
That's awesome. And very funny on the scalability perspective of that. To your point, So when I was selling single family homes, I thought I wanted to own 100 of them. But then you
Yeah.
realize quickly, well, that's to procure the whole debt process, go through the inspections, this, that. It's really, really challenging. But also, you may have to buy in other markets to accommodate the cash flow and those requirements, unless you're just basically saying, hey, I don't care about the cash flow. I'm just playing the appreciation game and long term. The money will come in at that point, and you basically play the equity multiple lift route. That's one side. But also, I experienced this when I bought my house in Arizona here, where, in the inspection report, it said one thing, but then $2,500 later, after my pool pump broke, that would have probably been my free
Sure.
cash flow on the property, right? As
Yeah.
opposed to the multifamily world or other, investment routes, that's accounted for in the business plan and the underwriting, right? So
Yeah.
it's very hard to scale single family. And the thought of managing 50 to 100 properties or, having that much out there, it's very challenging to keep track of that.
Yeah. And you think of the size of the business that you would need to have in place to support those types of investments. And it's just, it's over, as I said, it's overwhelming to think about it. We had a similar situation. We bought turnkeys. And by definition, a turnkey means that you invest the, 20-25% down. And then by definition, you're supposed to have cash flow coming in every single month from there. And that was anything but the case for us. We ended up we had an $8,000 roof replacement within a couple of months of buying the thing. We had $3,000 to $5,000 in plumbing issues and grading on the house. It was a total nightmare. So lots of learning lessons throughout that process that we've taken into what we do today. But single family single family passive investing, it's an oxymoron. Doesn't exist, I don't think. So
I will say this right now as well, and it's very funny, but appreciation is not free, especially on single family houses. The recurring maintenance on a property or any asset, that's a physical hard asset like real estate, is going to have, recurring fees associated that are not cheap. So as I said, appreciation is not free. So how did you get into real estate then? So it sounds as if you kind of found this from a kind of seeing around the corner, seeing what's next. You're in these sales roles. You figure out quickly that, maybe this is not the long-term path I want to do, as you maybe transition into the latter part of your career, which is, hey,
yeah.
I want to maybe be my own, my own boss and an entrepreneur and raise equity for deals. But, how did you get into it? So just from basically having your own curiosity, would you say, of figuring out investment opportunities for your retirement? What did that look like?
Yeah, so my dad actually was involved in multifamily apartments in Los Angeles back in late 70s, early 80s, actually up until he retired from the sheriff's department. So I think my dad had 100 doors at one point in LA. So that was always in the back of my mind that, the thought was once I got well established, once I got my financial house in order, then I would start to move into real estate investing in addition to what I was doing. At the time, I didn't intend for it to become a full-time job. I just assumed if I was making good money, I could filter money over into some type of real estate investing, and then that would help to kind of double or triple or magnify the earnings that I was making there. So yeah, I had got to a point in my career where I was maxing out my 401ks. We started accumulating some capital on the side, and I didn't want to put all of that money just into the stock market. I felt with my 401ks, I had plenty of exposure, and I didn't want to have any more. I actually watched my dad lose over 50% of his retirement back in 2000 when we had the stock market crash then. So I didn't want to have 100% exposure to the stock market. So like a lot of folks, I read the Little Purple Book, Rich Dad Poor Dad, as it seems like we all do, and it planted that seed that I needed to get started on this sooner rather than later, because I was getting crushed by the tax man in the 37% tax bracket, and it seemed like there had to be a better way.
Absolutely. So what was the first real estate deal that you did yourself that you invested in? And then what was the first maybe passive deal or deal that you raised for your company now?
Yeah. So the first active deal was that turnkey rental in Kansas City. It was $100,000 property, was supposed to be turnkey. So we were $20,000 or $25,000 down. And I think the thing was going to cash flow. Well, in the performing, it was going to cash flow a couple $100 a month. As I've already shared, it didn't come anywhere near that in the long run, but fortunately, fast forward a number of years, and since real estate is so very forgiving, we ended up making pretty good money on that deal when we finally sold it. It was now truly turnkey by the time we handed it off to the next investor, because we had invested a ton of
Right.
money. And I suspect it's a great investment for that person that bought it, but that was the first deal. The first passive deal I did was with a large operator that had a very big brand and a very big presence. I had listened to their podcast for a number of years, so it was one of the big personalities we probably all know. And I decided to put some money from an old 401k through a self-directed IRA account, and made all the mistakes that you make on those first deals. Even with that one, I put $100,000 in one deal. I didn't do a whole lot of vetting on the operator. I just figured he was on a podcast, so he must be reputable. He must do good. But all in all, that investment's paid very well, and has not gone full cycle, but it was a fund, so I didn't expect it to go quickly. And that was the first that got me going. And I mean, ultimately, without that first single family home, I would have never made that first passive investment. And I wanted to got to a point where I'm an LP in 24 deals. And now I've raised, $6.5–7 million for operators like you guys, and done 12 deals, I think, in the last year. So that first single family is what started the whole domino effect.
And that typically is the normal route, is single family, because it's the easiest to figure out. The comparable sets, it's very simple. It's pretty rudimentary in the regards to, hey, couple houses here in this subdivision sold for this price, has these features, maybe they said a little more square footage, maybe there's an extra bathroom, an extra bedroom. Okay, if rents are here, okay, you can really simply figure that out. But multifamily, self-storage, the short-term rental space, all that's a lot more robust than the typical asset. But that's also the beauty of it, is when it is so simple like that, it's a very, very fluid investment. And it's very liquid, because there's so many buyers, typically speaking, for a single family home as opposed to the multifamily route, which is awesome.
Yep.
With that said, you are in so many deals as an LP. You are looking to always probably raise for money. I think you're raising, you said, 12 deals in the last year, maybe, perhaps.
Mm-hmm.
So how do you vet a sponsor and someone you want to work with, from your own money as an LP, and then on your end for raising equity for deals? How do you vet someone? How do you figure out who's a good sponsor or not? Because there's a lot of good options, right? So can you kind of walk us through your thought process and what you're kind of seeking in that regard?
Yeah, absolutely. So kind of first and foremost, and you'll hear this from almost anybody who asks this question, is looking at track record, looking to see how long this operator's been in place, and how long have they done what they're claiming they're going to do on this next deal or this next opportunity. So that's always first and foremost what I look at. I will say that there are a lot of players that have been in the space for a couple of years. There are a lot of players that have been in 4 to 6 years. And there's much less people that have been in the space for 20, 25, 30 years. And I think, part of that is due to the fact that if you're in the space for 20 to 30 years, you probably get to a point where you don't need a lot of external investor capital, because you've done so well for your investors over the years that it gets much harder to work with those operators. So those are really kind of the first couple of things I look at. And I will say that now that I've got a number of years under my belt, the referral process has become more and more important to me, because there were a lot of operators that did very, very well during the last 5 years or so. And, I mean, almost anybody could have done very well in the last, 3 to 5 years or so.
You could have gone like this. Yeah, you could have been blindfolded, throw a dart, and basically bought a deal. And for the most part, it would have done fine, right? Especially if you bought it in 2019, 2018, maybe the first part of 2020, right?
Yeah, absolutely. And it's, there's a lot of guys that went to a Weekend Warrior event, not using Warrior to single out any, but there's a lot of those events that are weekends, and you pay your $30,000 or $50,000, and all of a sudden you're a syndicator. And
right.
Well, I will say that separates those folks from the folks that don't have the capital or don't have the experience or the bankroll to support those things. But again, it's very little in regards to education that you can't just find out there externally anyways. So finding people that have done this, that have had challenges, that have run into roadblocks and overcome those roadblocks, that's very, very different than joining some groups. So going kind of a step further, it's, after you find the folks that have some track record, they've got some teams. I like full folks that have fully integrated property management and construction management, because at the end of the day, this is a business. This is a very big business when you're talking about renovating potentially hundreds of units. So you've got to have as much control of that process as possible. And I think that's a really big piece. And then when you dig into the underwriting, everybody out there will say that they've got a conservatively underwritten deal. But what does that actually mean? Like, get into their assumptions and truly understand what they're talking about and make sure that it is conservative. So those are some of the things. I've got actually like a 200-point checklist that I'm like trying to get down to 80 to 100 because 200 is just too much, but trying to be as thorough as possible in finding those operators.
Right. And with that said, what are some of the key metrics that you do look for when you're kind of analyzing a deal? And, and also it's kind of interesting too, because you're not just raising in Texas with us or in Arizona with, a Rise 48 or whatever, ASIM Capital or whomever the sponsor may or may not be. So, what are the metrics that you look for? And then how do you also compare apples to apples or try to make it like that? Because naturally in Arizona with lower property taxes and insurance costs, your price per door is a lot more than what it would be in Texas, which has, very, very high insurance depending upon the market that you're in, and also higher property taxes, right? Which kind of deflates the price per unit, but the rents will be, maybe similar. So how do you kind of analyze these deals, make them really like for like as much as possible? So from an underwriting perspective, so what do you look for there? And, how do you kind of distinguish the two, or, the various states that you're in?
Yeah. So it's difficult. And I see a lot of people that operate in a lot of different markets, and I think it's difficult to operate in many markets. I have a hard time, honestly. I'm just in Texas and in Arizona with the deals that I offer to my investors, and Texas is a very big state, right? Phoenix, we primarily have Tucson and Phoenix, but in Texas, there's a lot of different markets out there. So insurance costs in Houston are going to be very different than Dallas or anywhere else in Texas as well. So it's important to kind of hone in on a couple of markets and then really just try to go deep and try to learn as much as you possibly can about all the operators that are in the space, and just spend a lot of time doing the research, listening to the podcast of the groups that are there, going out and walking properties, which I've had the opportunity to do on your guys' properties and a number of others in Texas as well. So I think it's important to really hone in on a business strategy and hone in on a geography so you can get to know those like the back of your hand. So once you've done that, though, I think it's important, especially today, for there to be a story for a property. Just going in and doing a classic value add business plan on any asset in Texas is probably not going to cut it these days. Like, you've got to have some angle, some strategy that's going to differentiate yours from the rest just to make the numbers work today. So I know you guys work on tax abatement. You guys have in-house property management. You have in-house construction management, which are critically important when you're dealing with these types of businesses. So I think those things are important to take a look at. And, looking at the underwriting, it's important to really get into those assumptions because, there's 100 different underwriting models that are out there, and the model is less important than the assumptions that you're putting into the model. You can make any deal work by adjusting those assumptions.
Or work, right?
Work on paper, right? Work in Excel. But to actually work in application, it's a very different deal. So, and that was one of the things that I liked about you guys is Rob literally wrote the book on underwriting, which is critically important in this space. Like, you don't get any deals at all if you can't underwrite hundreds of deals like you guys are doing. and I know maybe this is supposed to be a commercial, maybe it's not, but that's something that you guys do extremely well and really caught my attention when I was looking at partnering with you guys last year before last. So
Right. Well, that's awesome. And, with the metrics that you look for, are you kind of isolating rent growth? Are you isolating basically the DSCR? What are you really focusing in at? Like, what couple of things that do you look at right away when you kind of get sent over an underwriting model? Is there anything that you specifically look at, or are you just kind of at the point now that you've spoke with, and have only worked with a couple of people? We're like, okay, I know that if they send over a deal, I can just trust them, and then I'll just basically do a quick little check and run through to make sure that these are, congruent with the business plan and whatnot.
yeah, so going in cap rate and outgoing cap rate are really, really important pieces. And I look at that on every single deal. Rent growth and expense growth is like kind of the first one that I look at as well. So long gone are the days where we're going to see 10% rent growth. And, if you found anybody that's showing 10% rent growth ever in an underwriting model, I would just tell you to run.
Leave. Yeah.
Get away from that. So, and also looking at rent growth and how it compares to expense growth. If you see expense growth less than rent growth, then I would ask some questions about that as well. One of the things I see a lot of kind of rookie operators do is they'll come in with lower expenses than the previous owner because they think they're going to operate this deal better than the previous owner did. And it's very, very rare to actually see that happen. Yes, you might be a better operator, but odds are they held that asset for a lot of years. They know how to run it. And the new guy coming out of the weekend event is not going to be able to do a better job. And then lastly, property taxes and insurance are the biggest indicator as to, or some of the biggest kind of watch outs these days where, dollars per door on rent is really important. And also just insurance costs are going crazy right now. So those are really important things to take a look at too.
Absolutely. How often do you get sent deals, and how often do you get pitched from sponsors? Because I have to imagine you're very known in the space. You're a very friendly person. You're very open. You are not standoffish at all, which means you're probably a magnet for people to send you deals or people kind of wanting to pull from you. You're a part of so many amazing groups, and you really are, a known face in the space. Imagine if you go to a Hunter Thompson, Race Fest event, if you go to a BEC event, or even in Arizona, people know who you are, right?
Yeah.
So that said, how often do you get sent deals? How often do you get pitched from sponsors? And I guess, how many groups do you work with? Maybe let's start with that, and then go to the other questions.
So as of today, I work with 3 groups, 2 in the multifamily space and 1 in short-term rental. But I get pitched. I mean, I'll probably get pitched 3 times today. But it kind of goes back to that buy box as well. Like, it's really easy for me to say, like, how long have you been in business? How many full cycle deals have you done? Like, that will rule out 70% of the deals that come across my space. Another thing too, like I've made the personal decision where I only want to invest with operators that are within a 2-hour flight from me, just simply because I don't want to be flying from coast to coast over and over. It's just not a lifestyle that I want to do. So I can stick in Texas and Arizona, and maybe I'll go north into Salt Lake someday, maybe not. But I'm staying close to home. So yes, I get pitched all of it. Once you start raising a little bit of capital, everybody and their brother comes out of the woods and wants you to raise. And a lot of them get offended too if you start asking questions and then quickly disqualify them. So
yeah, and that's just part of the process. We've gone through that, and we still go through that all the time. And it's funny enough, on our end, we have a very wide range of people that we raise money from, right? We've got institutional players. We've got partners like yourself who are consistently bringing in $750K to $1 million, a deal. And then we've got partners that have never raised for a deal. Maybe they want to come with $500,000, or maybe, hey, they invested or want to invest 100 grand, and they pull together a couple of people and they come together as one check to get, Class B shares. So we do have a very diverse and robust range, but we get rejected all the time. And we get rejected from, partners who raise way less than you because we're just way too young. And then we rejected from REITs and big people as well. So it's very funny, but there's no point to ever getting offended. It's just, hey, you got to stay in the business enough. And, fortunately, this business is a compounding and appreciating business in the sense that you do well and you will get gimmies and you will get people that want to work with you and people that get referred to you. So stay in the game if you're an operator that is getting no's. The no's are fun because when you convert no's to yeses, it feels great. And we kind of feel right now we're at a point where, even in my year, we weren't getting as much time a day from some partners before. Now they're actually interested in working with us. And that's just due to persistence and maybe just timing as well. So it's just kind of part of the process in the game. We've done several deals together. What made you say yes to Lone Star Capital to start? So, naturally, there's a lot of good people out there you could work with. We're interesting because we're kind of that tweener where we're started in 2018. We have about $500 million of assets under management as we speak today. This is November 20th of 2023. So this will be airing in a couple of weeks. But we don't have a, massive exit list, right? So what made you feel comfortable with us then, with that said?
So first and foremost, I got referred to you guys by somebody who I have a longstanding relationship with that I know, like, and trust. So that's essentially what got you guys in the door and got me talking to you guys in the first place. So from there, I ended up spending quite a bit of time with the content that Rob and the team have put together. I bought the books that he published. I read those. I started talking around and asking other people in my network that I know, like, and trust about what they think about you guys as an operator in Texas. And you guys have a very good reputation. People speak very highly of you guys. What I liked about you guys as well was that you guys seemed more like, I don't want to say it's the other operators I work with are less professional, but you guys seem to take the reporting to another level. You seem to take investor communications to another level. It looks like an institutional quality investment compared to a lot of the other syndicators that I've worked with in the past. And it's interesting. I think in this space, there's a lot of folks that have big, long track records that are they've been raising capital from the same guys for the last 20 years, and they don't have the client-facing materials. They don't have the professional website and the images. They're not out in the marketplace from a marketing standpoint as well. And it was important for me to work with groups that have a big stamp in the marketplace, because I'm relying on your track record and your branding for my business as well. So even though there's other operators out there that maybe they've got longer track records and they've been doing this much, much longer, if they're hard to work with and hard to partner with, and they don't provide the resources that you guys provide to me, then that makes it much more difficult for me to be successful in what I do.
Yeah, because I have to imagine on your end, it's a chain of command. And when you pitch a deal and kind of present us, you're, basically positioning your firm, your group, impact equity with Lone Star, right? So it's got to be symbiotic in that regard.
Yep.
How much more of a handicapped process would it be if you're working with a sponsor who doesn't have a high level website or high level information and materials to distribute, in conjunction with the partner?
Yeah, good question. And it's something that I'm having to face right now, because I am looking at partnering with another group who, kind of fits all of those things. There's just an added level of uncertainty that I'm approaching based on a very strong recommendation, but I'm nervous about what the investor experience is going to be in that type of environment, because it's very, very different than having a dedicated person like yourself or the other partners that I have within Lone Star. And anytime you put uncertainty into the space and you don't understand what, like, the step-by-step process is going to be, then that makes it much harder for me to translate confidence to my investors. And ultimately that will show in the results. So you guys are an open book. You say very clearly, do X, Y, and Z, you're going to get A, B, and C. And that has happened every single time. So predictability is really, really important in this space. And you guys have done a great job with that.
Thank you so much. I appreciate that. And now the Lone Star Capital ad is over.
Yeah.
But thank you so much for the promotion. And it is just nice to hear on your end what kind of separates us. And hopefully, if you're a fund manager looking to partner with a group and you're looking for options, and you're looking to start, we really want to equip everyone with the best information possible and ultimately give everyone a white gloves treatment. All right. We want to make sure that you feel like you're supported and are set up to win, because this is a team effort. And with what we'd like to do, there's plenty of space in our capital stack for equity partners who are in that kind of $500,000 to $2 million range, which obviously you fit in. And they're very key because there's some deals that are not ready or right for institutional people. And then there's some deals that, hey, perfect, we have an institutional partner, but we still have a couple $1 million to raise, and you're one of our go-to people. So for anyone out there looking to kind of learn more about that and see how that fits in, reach out to me, of course. All right, Lone Star Capital ad is over. How has capital raising changed for you over the last year with the shifting market? And what has kind of been the difference between when you started, which is a couple of years ago, to now? Has there been a lot more kind of hand holding? Has it been harder to hit the raising goals? Kind of talk to me about your experience recently.
Yeah, so I mean, certainly the market is more difficult today to raise capital than it was when I first started. I came out of the gates pretty strong and had, my first deal was just under 1 million. My next deal was just under 1 million as well. And those went pretty quickly. So I think, as a newer capital raiser, there is this process where you ultimately raise from friends and family, and direct relationships initially out of the gates. And then you've got to go to the next phase where you start building top of funnel. You start getting your name, your brand, your image out there to really start attracting new investors. And that's been challenging. There's a lot of people that are throwing a lot of marketing dollars at getting accredited investors or even starting relationship with sophisticated investors. So that's been the main challenge over the last, I would say, 6 months or so. Going into the end of year last year, I believe when I first did my first deal with you guys, that first deal with you guys went pretty easily. But the last few deals that I've done with another partner have been much slower in the last handful of months. So, we're still trying to figure out what is going to be the differentiator. Is it everybody sitting on the sidelines right now and have tighter wallets than they have? Do we need to see a shift in the economy and possibly interest rates before people feel comfortable? Or, is there some other kind of golden egg strategy that we'll be able to identify to get more people into the space? And I think it's an important question, because this is like, now is the time to be investing in this space, even more
Right.
so than when I started last year. And for the folks that are, my avatar is the high income W-2 sales guy, a previous version of me, essentially. And for those guys that are sitting in the same position that I was, last year, 15 months ago, or 13 years ago when I got laid off, you've got to have a strategy to decrease your dependence on that W-2, because the layoff is just around the corner. Speaking from full experience, I was a top performer in both of my roles for many, many years. And yet, if your name lies on the Excel sheet when the layoffs come, you're getting laid off. So you have to have another strategy. That's my 2 cents there.
Yeah, absolutely. So do you think more recently as well, with regards to raising for an individual deal, that you've had to do a little more phone calls, more follow up? Because I remember it to start the year, and then the middle of the year it kind of got a little bit barren, and then now it's kind of funny. It's 2023, the end of the 2023, where people are looking for maybe some offsetting of taxes. So there's a big uptick right now as people kind of
Sure.
starts tax plan for their year. But I recall kind of over the summertime, it was double, triple calling, texting, emailing. And I'm kind of funny. I like to make sure I kind of mix up my sequence. If I'm just called them last time, I'm going to send them a text. And if I
Yep.
just text and call them last time, I'm going to send an email. But I don't want to do everything like that. So I try to stack it out and do it differently in that regard. But are you seeing a little bit more hand holding and kind of a lot more leading a horse to the water? Because before it seemed as if you would send out a couple of emails, and we were this way too. People would kind of get on your calendar. They would make themselves very available because their motivation was there. So are you kind of experiencing that? And how do you kind of handle your follow-up process, because you don't strike me as someone that's gonna, make anyone feel uncomfortable, do anyone push anyone. You're very much so a, hey, it needs to make sense for you, and a very
Yeah.
reasonable and empathetic person. So how do you kind of see the differences, there with regards to touch points and conversion?
Yeah. So it's hard for me to say that. Um, it's hard for me to say whether it's harder now than it was in the past or not. My strategy, being in sales for 25 years, has been very similar to what you just said. I'm a call, text, email guy. I used to do when we were hardcore cold calling, we used to do like an AM PM next day strategy where you'd call in the morning. If they don't answer, you call in the afternoon, and then call the next day. I'm much softer these days in this approach because I don't think anybody wants to be hard sold an investment. I don't want to hard sell anybody in this space, anyways. If it makes
No.
sense, great, right? What I do know is that passive investing from an LP standpoint, 9 times out of 10, it comes down to timing, right? So if I've had the initial contact with somebody and there is a relationship and I've been able to display that I'm educated and I'm competent and that I can find good deals, then I feel very confident that we're going to be able to do business and potentially help this investor sometime in the future. So
Right.
I have a regular email cadence. I do a monthly newsletter. I try to touch customers, people that have invested with me, every 2 to 3 months at a minimum with a phone call or a text. And people that I have into the pipeline that haven't invested, then I usually will do basically follow up with them until one, they say to stop following up, or two, it's been somewhat exhaustive, and then I'll push it out another 4 to 5 months and then start that process all over again. So I'm a very heavy CRM user guy. The CRM manages 90% of my day. And if you just have that regular cadence built into it, then you're going to keep touching those people when they need to be touched. So
Yeah, naturally. And I love that. And to your point on hard selling, you never want to work, and being a salesperson, I am too. I've been in sales my entire career as a, professional. Likewise, it seems like you have too. With that said, if you feel like you ever have to hard sell a product, you should not be selling that product. You want to be
right.
working in a situation in an organization, or be doing something where the product for the most part can sell itself, and you're
Yep.
answering high level questions and making people feel comfortable, and breaking it out in an educated manner, right? So if you
Yep.
feel as if, or one feels as if they have to be there, you should for sure consider a different product type to sell. That goes,
Yep.
there. With that said, you kind of mentioned your avatar as well. So your avatar is high income salespeople that are, maybe call it 35 plus, that are maybe coming to some money, but they need to kind of figure out ways to, not be as reliant and wean off their W-2 income, or basically set up themselves to, have other sources of income. You said you also had a second avatar, correct? Can you just touch on that as well too, please?
Yeah, so I mentioned that I am one of 2 different avatars. I'm
Okay, gotcha.
either the sales guy turned capital raiser or the active turned passive investor. Those are the me as an avatar. But no, very specifically, my avatar is high income W-2 financial services, primarily financial services sales or technology sales.
Right. And for those who don't know, an avatar is not, well, in addition to the movie, it is, who an investor it is. It's who you're speaking with. And the spaces that we're in, if you're in Hunter's group, if you're in Sam's group, getting very niche to, in their mastermind groups, they'll teach you in this, get very niche and specific to what you're seeking, what you're looking for, and who you are. Because if you're speaking to everyone, you're speaking to no one. So if you can go hyper specific and focused, it will make you better for it. So just wanted to hit on that right there. How long does it usually take to convert your investors, and where do you typically find them? You said, is it referrals usually? Do you find them via LinkedIn, through Facebook groups? Can you kind of walk us through that?
Yep. Yeah. So my breakout, the last time I did the analysis, was about 1/3 of my investors, and I have 94 investors now. About a third of them are true friends and family. About a third of them are people that I previously worked for, or not worked for, worked with, or were clients. And then about a third are actually referrals. So the top of funnel strategy that I have is probably only 10% of my investors at this point. So it's a very small amount, which shows that I got to spend much more time there. But I think that referral piece is the strongest way to get new investors, because people who have, and I had a conversation with a gentleman last week that was a referral from my number one investor. And, you know, the conversations that go, so-and-so trusts you, so I trust you, where should I put my dollars? Those are the type of conversations I want to have all day long. What I find is the people that I get from LinkedIn or social media or things as such, those are much longer sales cycles that can take. I mean, I have a guy that just invested with me that I've been talking to him for over a year. So you never know. You never know. But referrals have a much quicker close rate, certainly.
That's awesome. Yeah. And those are usually the warmest leads, someone who's motivated. Maybe it was, hey, you know, a group of people get together, some spouses get together for a glass of wine, and you talk about your investments naturally, and then they speak highly, and then they think, oh, yeah, I actually have a need. And maybe this
Yeah.
is really urgent. It's very quick. You know, referrals to your point, tend to be some of the hottest and quickest conversions, whether in any sort of cycle in business. So that's awesome to hear. Moving and switching gears to kind of market talks and conversations as we kind of conclude and get to the end of our fun conversation here. What assets do you think will struggle the most coming up here in the shifting market?
I mean, clearly office is struggling. You know, we're seeing that. I think there are some estimates that we're going to just see an amazing amount of foreclosures in the office space. None of those banks want the assets back, but if you got people handing over the keys, they're going to have to figure out something to do with them. So I think office is going to get crushed. I think that there's a very large number of new assets coming into the market space. So I think we're going to see concessions in A class continue to be a challenge moving forward. But I think B plus, A minus assets are really the place to be. Maybe B value adds, but yeah, I think office are the biggest struggles, and then the very large new development stuff is going to be very, very, very competitive in the future. So
Right. And that was my next question is, what do you think will be the best asset coming up to be a part of?
I love Class B value add. Give me an asset that's 20 years old and needs, you know, renovations. That's an easy cookie cutter approach. So that's what I like the most.
Yeah, and we feel the same as well, because that's probably typically workforce housing. The issue or that the country faces is that it's impossible to replace and replicate, you know, or it's impossible to basically develop workforce housing at an affordable spot from a developer perspective. So
Yeah.
playing in that space is really, really smart on our end and on your end, because there's a shortage there. There's a supply gap there. You know, for A class, there's always better and the latest and greatest amenitized property, but there's oftentimes mismanaged or, you know, not maxed out value add kind of plays that are kind of 2005, maybe 2010 to, you know, 1970. Big range there. It can't be replaced. And, you know, more people are in that workforce. You know, the country basically lives in workforce housing. So
Yeah.
it is an incredible tenant and a space where there's a lot of enhancements and dollars to be created there.
Yep.
What is
And
your,
let's
yeah,
sorry to jump
you're
in,
good.
but let's not forget the value add strategy of tax abatement, which is the most exciting value add strategy, I think, in the marketplace today. And I think we're going to see more and more of it as affordable housing continues to be a bigger and bigger issue. So I think it's
Yeah,
important to partner with groups that know this space or are learning this space, which you guys, of course, are becoming much more well versed with. So
Yeah, can you expand on that as well? You know, how do you kind of break that out to your investors? Because, you know, looking at workforce housing is not the sexiest asset. And then also looking at, oh, tax abatement deals or deals with an affordable restriction, what does that look like, right? Because that's not, you know, the sexiest looking deal, but the numbers really make sense and can sometimes pop off the screen. So how do you kind of pitch that, hey, oh yeah, you're going to get incredible returns, but yeah, also it's going to be created by, you know, capping some of our rents, right? So can you kind of walk us through how you
sure.
break that down and you know, convey that message to your partners?
Yeah. So I mean, at the very high end, we've been talking about this throughout the call. Insurance or I'm sorry, taxes are one of the largest single line items on the P&L for a multifamily syndication or development, whatever that is. So if there is an opportunity to completely take that line item off of your P&L, it has a very, very significant impact to the bottom line. So as an investor, you're going to get significantly better returns, i.e. cash flow, cash on cash return from day one, if we can put a tax abatement strategy in place. Now, what's kind of interesting about the rents that you have to offer to these folks in affordable housing, quite often those rents are going to be at or even above the in-place rents because of the rents that you're allowed to charge in affordable housing situations. So, and you could probably talk through that better than I can, but my understanding is that quite often we're not even having to drop the rents to some extremely low amount in order to fill those seats. So combination of not paying the taxes, and then you've got this tenant base that I suspect if you're able to get into affordable housing, you're probably going to stay longer. And another very large expense in this space is turnover. So if we can keep them there longer and we don't have to pay taxes, it's really just kind of the perfect marriage for our investors, for our operators, and for the tenants as well. So
absolutely. And thank you for breaking that down, because it is nice to hear other perspectives on the matter as we,
sure.
are in the weeds on that naturally as well.
Yeah.
What's your favorite part about capital raising?
Boy, I will say it is a difficult job. My favorite part about it is probably that I'm giving investors opportunity that I have been able to take advantage of as well. And when you see that moment when the light comes on about what this can mean for their financial future, I think that's probably the single most exciting thing about what we do is when you see somebody and they start doing the math about investing 50 grand and seeing that you can double that every 3 to 5 years. And God forbid, if you invest 50 grand every year or once a quarter, like the amazing impact that can have not only on net worth, but actual livable wages or livable income that you can create
Lifestyle.
from those investments. It's unbelievable. You
Yeah.
hear everybody talk about work-life balance and spending more time with the family and all of those type of things. Like if you could create just $50,000 a year in tax advantaged income, what kind of impact would that have on you? And like, there's not a person out there that it wouldn't change their life dramatically if they had an extra 4 to 5 grand a month coming into their bank account. So I think it's a big deal. And it's something that, I want to get on my soapbox because I didn't even know about this space until about 6 or 7 years ago. I was 45 years old before I even knew about the syndication space. And, I've got a very good friend he's in his late 20s and he's in 7 different syndications. And I just think, this guy can retire by the time he's 35, So anyway.
Yeah, that's awesome to hear.
Deal. Yeah.
Final question. What is your hottest real estate take?
My hottest real estate, like a best practice or
just a hot take? Maybe you could say, hey, I think XYZ market is going to crash and burn and here's why. Maybe a philosophy, but something that is specific to you, maybe a core philosophy you believe that maybe it could be controversial, maybe it goes against the grain. Your hottest take.
Okay, so this is maybe not real estate related, but I have grown to despise the 401k plan more than anything in the world. I think it's the biggest scam that we're teaching young kids. Like the goal to teach your 21-year-old to pay into a 401k plan when their tax rate is probably lower than it will ever be their entire life. And we're trying to get them to not pay taxes today. And then those dollars are trapped and cannot create livable income until you're 65 years old. So I'm not a big fan of 401ks. So that's my take. Invest in real estate starting today is my biggest advice.
I love that. I've told this story before on, I think, several different channels, but the biggest tiff and argument my dad get into is why am I not putting more money in my 401k and my self-directed IRA? He is a long-term 30 plus years at Morgan Stanley guy, loves that stuff.
Sure.
And that's the biggest argument we get in. I'm like that. I'm investing in real estate. This is tax advantage, as you alluded to earlier. And I believe in it long term. And I'm going to look up when I'm 50. If I invest in times as a 29-year-old with deploying X amount of dollars every single year, and I will be able to work at my leisure, is my opinion with how you kind of financially model things out. So that's what I'm seeking for. That's what I'm solving for. So I could not agree with you anymore. Randy, it's been such a pleasure to have you on the show. Can you let everyone know where they can find you, reach out to you? You have a podcast. Give yourself as many plugs and ways and avenues to find you, please.
Absolutely. Yeah. So the easiest way to find me is impactequity.net. I do spend a ton of time on LinkedIn. So for the fastest response, message me on LinkedIn. And then, of course, I've got a podcast that is geared directly to the newer passive investor. It's called The General Art of Crushing It. We've got a Thursday show where all we do is focus on educating that avatar, and reach out. Would love to chat.
Absolutely. Well, thank you so much for being on the show. A friend, a partner, looking forward to only working with you more and more to close out 2023, 2020, 2024, and beyond. Thank you so much for being on the show, and we'll catch everyone next episode. Peace.